I'm sitting here with Morten Brøgger, CEO of MapsPeople. You just recently announced that you have acquired Point Consulting's indoor activities. I guess it's the customer contracts and the technology you acquired. Can you give us a little bit on what it is you have acquired and maybe a little bit on how that fits into MapsPeople?
Yeah, absolutely. So you're absolutely right. It's the indoor mapping activities from Point Consulting that we acquired, which means that we have acquired the customer contracts they have and the rights to embed the technology components that we choose into our technology. It is mainly airport customers that Point Consulting has done. So there's actually a pretty great fit into the 258 airports that we bought a little bit more than a year ago from a Point inside. And that has actually been driving a little bit of growth from us ever since then.
Can you give us some details on whether you have opportunities to reach more into this vertical, more into the airports with these two purchases?
Yeah. There is, in my opinion, absolutely some opportunities to grow this. The business both grow the existing customers that we have, but actually also the whole combined data set we have now with almost 300 airports, right? That gives us an opportunity to kind of excel those indoor mapping and those data sets behind that to a higher extent. So that just strengthened our position in this way. It also strengthened our technology. And then we, as part of this agreement with Point Consulting, they actually become a value-added reseller of MapsPeople, meaning that hopefully they will continue the good work that they've done, and they will continue to sell to more new airports, but this time directly into MapsPeople's technology.
And can you talk a little bit about the transaction price and the financial impact this will have on your business?
Yeah, let's start with the financial impact it has on the business. These are all recurring revenue contracts. They will add around 2.1 million Danish kroner in annual recurring revenue. Since we don't really take a lot of cost on, it comes in with an EBITDA margin of at least 75%, meaning that it will impact our revenue next year with the 2.1 in AR. It will also impact our EBITDA positive with 1.6 million next year. And that EBITDA impact is also equal to the improved cash flow from these activities in 2025 as well. In regards to the price, the deal was structured as an ARR multiple, and the combined price can be up to 8.1 million Danish kroner, which is approximately 3.8 times the ARR that we acquired, which is fairly similar to how MapsPeople has traded. It comes in two components or two phases. The first phase is really here and now, which is around 2.5 times the ARR. And then there's an earn-out opportunity of 1.3 times ARR over the next 12 months, which is linked to all these customers that we have acquired, is renewing their contracts going forward with a minimum 12 months renewal. And combined, if all these 3.8 times ARR, that sums up to around 8.1 million. 6 million of those will be paid in cash, but in those two categories I just mentioned before, and 2 million will be paid with new MapsPeople shares that we will issue.
And I understand you use the ARR multiple, but actually I look more at the EBITDA and the cash flow multiple. Here you're paying around 5 times. That you don't get many assets for that price. So can you talk a little about, is this the new blueprint for your M&A model? You will use 50% of the recently acquired cash. I guess it's much lower risk. You don't take over people, you take over the contracts, you run those contracts and the maps in your machine, actually meaning very low risk. It's cash flow from start on, and it's not that many times cash. So is this the blueprint for what you want to do in the M&A? Meaning also it's a blueprint for the risk you're going to take on in M&A transactions.
Yeah, I agree. It's a good blueprint. It's a good model, which is also why we chose this. But it also fit very well with the seller, what they really wanted to achieve here as well, right? They wanted to continue the company. They do a lot of other stuff around the indoor mappings. They wanted to continue to be able to do indoor mapping, and that is solved by the reseller. but actually it takes a lot of investment to be in this industry, and this is why they thought this was a good idea. Whether the next one will be a similar blueprint or more traditional blueprint, I actually don't know at this point in time, Michael. But obviously this is a good blueprint for it, because I do agree. If you look at the ARR multiple, it's probably a little bit in the high end, but it's comparable to how we're trading. But if you look at it from an EBITDA multiple or a cash flow multiple, it's actually pretty good.
Pretty interesting. And let's finish off. I know you can't. I asked you whether it was a blueprint for the model, and I know you can't be too specific. But do you have more in the pipeline? Are there many of these types of assets out there, and do you have some in your pipeline the remainder of the year, even it's running out?
Yeah, I'm pretty sure there will not be for the remainder of the year, because the year is running out, right? But as we stated when we did the capital raise in last quarter, we do expect somewhere between 2 and 3 until the end of 2025, and nothing has changed in that ambition. So I think we need to let it stay at that level.
Perfect. Thank you.
You're welcome.